Namaskar dosto, welcome back to the Stock Info. Today in our episode 30 we are going to discuss an important subject: build a recession proof portfolio, gold ETFs, low beta defensive stocks and completely safety framework. Sensex dropped 455 points this week. Gold has increased by 1715 one day. Your portfolio can be designed to survive both. In our section 1, the gold versus equity, live contrast, most dramatic opening in 30 episodes of the series. This week, the Sensex fell 455 points, Nifty slipped below 24,600, financials fell, oil stocks fell, portfolio values fell. And on August 5th of this week, gold jumped 1,750 in a single day. On the same week, equities fell, gold rose. This is not a coincidence. This is a correlation, or more precisely a negative correlation we can say. A portfolio engineered correctly uses this relationship deliberately. Now, today gold in Bengaluru is 1,49,890 rupees per 10 grams. In 2019 it was only 40,000 per 10 grams. That is 275% gain in 7 years while paying no rent, no insurance, no storage cost, and the best part, you can own it without storing it, without worrying about the purity, and without paying making charges. Through a gold ETF traded in NSE exactly like a stock. This is episode 30. How to build a portfolio that survives and in some parts actually grows when market fall. Now in our section 2, why gold belongs in every serious portfolio. Build the investment case for gold not as a speculation but as a portfolio engineering. First, understand what gold is in portfolio context. Gold is not an investment in growth. Gold does not pay dividends. It does not generate any earnings. This has no ROCE. Then why hold it? Because gold is an insurance. Insurance against equity market crashes. Insurance against currency devaluation. And insurance against geopolitical uncertainty, which is why the gold jumped 1,750 when Iran-US tensions returned this week. The academic term is negative correlation with equities. Now, here what we can say is when the equity markets fall, investors globally sell risky assets and buy safe haven assets. Gold is the oldest, the most universally trusted safe haven asset in the world. Central banks of India, China, Russia and USA all hold significant gold reserves precisely because of this property of the gold. In a portfolio context, holding 10 to 15% in gold means that when equities fall 20%, the gold portion may rise 10 to 15%, cushioning the overall portfolio impact. This is not a speculation on gold price. This is portfolio engineering using asset classes, correlation deliberately. In our section 3, what is a gold ETF? How it works? How to buy it? The most practically new section. In 30 episodes, gold ETFs are genuinely new knowledge. A gold ETF, exchange traded funds, is a fund that holds physical gold on your behalf. Each unit of the gold ETF in India represents approximately 1 gram of 99.5% pure gold. When you buy one unit, you effectively own 1 gram of gold without storing it. The fund holds the physical gold in a secure vault in the custodian bank. You hold the paper, the ETF units in your demat account. You buy and sell it on NSE or BSE exactly like you buy and sell TCS or HDFC Bank share. The price moves in a real time with gold prices. Now here is what it makes gold ETF significantly better than the physical gold for investors. No making charges, Physical gold jewelry costs 5 to 20% in making charges. Money that never come back always. No purity risk. 99.5% purity is guaranteed and certified by the custodian. No storage cost. The fund handles vault storage for a small expenses ratio of 0.3% to 0.65% annually. No safety concern. Your gold is custodized institutionally, not sitting at home. The four main gold ETFs in India: Nippon India Gold ETF called Gold Bees, HDFC Gold ETF, SBI Gold ETF, and ICICI Prudential Gold ETF. All four are among the most liquid ETFs on Indian exchanges. You need Demat account, which you likely already have for your equity portfolios. No new account, no new broker, same platform, different asset classes. Now coming up, the low beta defensive stocks that form the other layer of the recession portfolio, and then how to combine both into a complete framework. Section 4, low beta defensive stocks, the equity cushion. Short 47 beta applied, the direct series connection that rewards loyal viewers. From short 47 beta measures how much your stock moves for every 1% of the Nifty move. Beta 2, your stock moves twice the market, double the upside, double the downside. Beta 0.5, your stock moves half the market, half the upside and half the downside. In a recession or a bear market, you want the half the downside property. This is why defensive stocks are the foundation of every institutional recession portfolio. From episode 19, defensive sector, FMCG and consumer staples. People continue buying toothpaste, soaps, rice and medicines regardless of whether Sensex is at 224,000 or 80,000. This revenue stability translates to stock price stability and low beta. Hindustan Unilever Limited, beta approximately 0.5. Nestle India, beta approximately about 0.4%. Sun Pharma, the beta approximately 0.5%, and Marico Industries beta approximately 0.5%. When Sensex fell 455 points this week, these stocks fell significantly less. Their fundamental revenue, toothpaste, shampoo, pharmaceuticals, did not change at all. The recession-proof portfolio deliberately overweighs defensive FMCG and pharma in its equity allocation. Now, here in this episode 28, ROCE, notice that HUL ROCE is above 100% and Nestle ROCE is about 90%. High ROCE and low beta and defensive revenue. This is a triple quality filter for the equity portion of the recession-proof portfolio. Next, in our section 5, the complete recession-proof portfolio framework. The most practically valuable section, assembling the complete multi-asset framework. Let me now put all the pieces together. The recession-proof portfolio has 5 layers. Layer number 1, gold ETF, 10 to 15% of the portfolio, zero beta, negative correlation with equities and the safety valve. Then layer number 2, defensive equity, 25 to 30%, FMCG and pharma with beta below 0.6%, Hindustan Unilever Limited, Nestle, Sun Pharma, high ROCE from episode 28, stable revenue regardless of economic cycle. The cushion, layer number 3, quality growth equity 30 to 35%, IT and select consumer discretionary. TCS, Infosys with ROC of 35 to 60%, FCF, quality confirmed, short 47, moderate beta. The engine, layer number 4, rate sensitive 15 to 20%, private banking names using short 49, PB bar ROE framework, HDFC Bank, Monitor, NIM, NIM trend and short 51, only quality names with a sustainable ROCE. Then the optimizer, layer number 5, cash and near cash, 5 to 10% liquid funds or short duration debt funds. The opportunities, opportunistic reserve to deploy when the market falls significantly. Total portfolio beta weighed average across all the layers should be 0.5 to 0.7% in recession ready mode compared to pure equity portfolio beta of 0.9 to 1.2%. The recession proof portfolio takes less market risk when capturing most of the long term equity upside. This is what institutional wealth managers build for conservative clients. Today you have the exact same framework. In our section 6, we are having a live demo of buying gold ETF, checking defensive beta on the NSE and NSE and Yahoo Finance. Okay, now go to any Google browser and type nseindia.com. This NSE website will gets opened. Here type the gold bees, gold bees. Gold base. Click on the ETF here. Nippon India ETF gold base. It will appear. Click on Nippon India gold base. Here we can see the gold base of Nippon India. It is trading at 123 rupees point 40 paisa. See, the stock movement is going up steadily like this. 122, 123. Now it has reached up to 123. Then many other gold Vs are there, many other gold ETFs are there. You can compare the prices before you take an decision. Step 2, then check whether the gold is rising comfortably. We can see this gold is rising comfortably here. Then we'll compare with, in the step 3 we'll compare with other gold ETFs. Here HDFC gold ETF is there. We shall see HDFC gold ETF. Type on ETF. You can see HDFC gold ETF here. Click on the HDFC gold ETF. It will appear here. It is trading at 127.4445 paisa. See, this is also, it has started from 126, slightly it moving upward like this. You can see the upward movement of the price of HDFC gold ETF. Then we shall check above SBI gold ETF is also there. You can see SBI gold ETFs. Type on SBI, type on gold ETF. SBF ETF gold is available here. Click on this. You can get here. The SBI gold ETF is trading at 127.36 paisa, and see the movement of the gold ETF. It has started from 126.4. It is moving up slowly like this. Okay, these are the price movements we have to see. Then how to buy this gold ETF? This buying this gold ETF is very simple. Go to your broker app, place an order as you do for your stocks. It will be get credited to your demat account, and you can purchase more or sell at any time you want. This is about the gold ETF. Then in the next step, step 5, we have to see the defensive stocks. Open this Yahoo Finance. Yahoo Finance, here you can see the beta. Actually, go to this Yahoo Finance. Here we'll see this Yahoo Finance. Type Yahoo Finance in the browser here. It will get opened here, Yahoo Finance. Then in the search list, type Hindustan Unilever Limited. We shall see Hindustan Unilever. Hindustan Unilever Limited has come here. Click on this Hindustan Unilever Limited. It has, the page has opened. It's presently trading at 2,080 rupees. Here you can see the beta. The beta for 5 years monthly, it is 0.27 only. That is very good actually. It will only change for the 0.27% for the NSE corrections. So the stock movement will not be more here. Then you can see that Nestle India also. We shall see the beta of Nestle India here. Type Nestle. Nestle. Nestle has opened here. See the Nestle. Oh, this is not Nestle of Nestle India. Nestle India Limited here. You click on this Nestle India Limited, you can see 1540 rupees. Now you can see the beta here. Beta for the 5 years, it is 0.43 only. So the beta of Nestle is comparatively more than the Hindustan Unilever Limited. Like this, you have to check the beta of any stock before taking any investment decision. These betas are your defensive stack anchors. Then in the next step, for any defensive stocks, you consider verify beta below 0.7 on screener.in or ROC above 50% as per episode 28, OCF or profit above 70% from episode 23, all three together. Then in the next step, rebalancing check once a year, compare your actual allocation to your target. If gold ETF has risen significantly, say 20% of your portfolio due to equity market fall, trim back to 15% and redeploy the equities accordingly. These are the some of the steps you need to take while constructing your portfolio. Section 7. When to add more gold to reduce the rebalancing rule. The most professionally sophisticated close signals for gold allocation changes. When should you add more gold to your portfolio? Signal number 1, short 50 FI activity. When FIs are selling Indian equities heavily for 3 or more consecutive weeks, global risk off is happening. In the risk off environment, gold historically outperforms. This is your early warning system from short 50. Signal number 2, Nifty P from short 38. When Nifty P exceeds 25 times, markets are expensive by historical standards. Add gold to reduce overall portfolio risk at an expensive market levels. Then signal number 3, geopolitical events. Iran and US tension, Israel and Gaza escalation, US and China trade disputes. Each of these pushed gold higher this year. When should you reduce the gold? When FIs consistently return as buyers, short number 50, pattern number 1, both FIs and DIs are buying together. This signals equity risk is back in favor. Reduce gold from 15 to back 10%. Redeploy the proceeds into a quality equity using the episode 19 5-step framework. The recession-proof portfolio is not a permanent configuration. It is a dynamic system that adjusts allocation as the macro environment changes. Comment below, do you currently own any of the gold ETFs? And if not, what has stopped you? I reply to every day. This is episode 30. The series continues. Please subscribe, like and share with family and friends and support me for bringing more and more good videos for you. And thanks for watching this video.